And now a very special guest joins in. Gautam Chhaochharia, Head of Research at UBS, is joining us. So Gautam, good morning. Thanks for joining. All eyes on results with TCS and IndusInd Bank coming tomorrow. Well, if you look at the last quarter numbers, in fact, market kind of peaked if you're talking about, Nifty or Sensex towards the end of July after, we saw the quarterly numbers. Will this quarter give us any relief to markets?
So this quarter, good morning to all of you. This quarter is a bit tricky given the impact of GST and how it could impact the reported numbers. It's difficult for us to be sure how the reported numbers will be interpreted. Having said that, if I look at street expectations per se, there is some level of positive impact from restocking being built in into estimates for second quarter. But what I would say is two things how from a market perspective. One is the implied growth rates for second half is still way too high. So if the Q2 estimates, which is kind of building in GST restocking benefits, is delivered, the implied growth rate in earnings for second half is around 19-20%, which seems stretched to us, and which means there will be further earnings cuts ahead. Secondly, from a market's perspective, what would matter is the management commentary in context of how they have seen demand trends, specifically in the month of September and October. So the reported numbers will obviously be impacted by supply chain issues around GST, but the underlying demand trajectory, specifically around September, October, would give markets some sense of direction about what could happen in the second half. And normally we do know that corporates are always optimistic, specifically about second half. But the commentary I'm talking about is specifically around what they are seeing in September, October. And that will give you a good sense of direction. And that will possibly set the tone for market trajectory. Because second half recovery is again, just like 3-4 years, is the big hope trade for markets right now. And if you don't see that playing out, that would be a big negative surprise for markets here on.
So we do have some high frequency data really to work with, like auto sales numbers or the core sector growth, things like that. How do you really see these numbers, and doesn't that support the kind of optimistic projections we have for second half?
So in our analysis, no, because we've been tracking this high frequency data regularly over the last few years. And as you've seen over the last 3 years, at any given point of time, there are few data points which always seem optimistic and few data points which seem suggest that economy is not in a good shape. So even now we are seeing a mixed bag. If you're talking about car sales and two-wheeler sales, they've been reasonably positive for a while, including in the first quarter when the GDP print was 5.7%. And there's also the variability because of base effect, etc. So we have seen in many core industry data, the monthly data points are quite volatile. So you could have a period where the last year's month growth rate was in the negative territory, and you see a good Y&Y print in this year's data. So what we typically look at is disaggregate and aggregate and try to smoothen it out and see the underlying trajectory about what they're suggesting. So to us, it still suggests that the economy is in a similar shape as it was 6 months back or 2 years back, which is broadly okay, but no sign that it will go up in a hurry, and no sign that it's going to be in a very weak state as was being speculated by the market about a month back.
Mm-hmm. So I understand that you have cut your earnings expectations of late. What has been the extent of this cut?
So we are always expecting earnings cuts to happen throughout the year. We just incorporated the impact of GST into the expectations. So we are now expecting earnings growth rate of 6-7% for fiscal year 18 and 12-13% for fiscal year 19. Okay. This is a top-down forecast. The analyst estimates can vary.
Okay. The sectors we have been talking about, IT is always the first that one looks at because TCS will come out with the numbers. Infosys, of course, has deferred the numbers this time around. What are you expecting? Could there be some positive surprise? I mean, in any case, this is not an over-owned sector as of now.
So can't comment on individual stocks, but yes, IT services numbers will likely be muted. But the key point here is that the expectations are already building that in. And we were negative on IT services sector for last 3 years. We didn't have a single buy rated name. But a few months back, we did turn tactically positive. As the point you mentioned, it's under-owned, valuations are reasonable, and more importantly, expectations are quite low. So for example, even in the first quarter, where the numbers were not great, they didn't surprise markets negatively. So even for the second quarter, our view is that the expectations are quite realistic. And the numbers, while they may not be great, but unlikely to be a negative surprise. And at the margin, if the commentary has positive undertones, specifically from some pickup in US spending, that could be at the margin a positive. So tactically overweight, but yeah, the structural concerns still remain. And there are individual ideas which we're still comfortable with recommending here.
Well, banking is the next sector with IndusInd result also expected tomorrow. Again, I'm not talking about the stock per se, but the sector, if you look at, will private sector results be as good that justifies the valuations that we currently have for both private sector banks and NBFCs? And will PSU numbers, will they be really so bad?
So it looks like the trend will continue in terms of retail-focused private banks doing better than corporate-focused private banks, and definitely doing better than the SOE banks. Even NBFCs should be in a better shape. So we do expect some moderation in the mortgage finance given the data points we have, but they should still deliver robust top line as well as earnings growth. And even the private banks, even the corporate-focused private banks, while we could see muted earnings, there is a possibility of provisioning coverage ratio that could improve further in this quarter. And that's the trajectory which we would like to see continue for a while, and then these stocks could become interesting.
Well, Dena Bank has come out with the QIP. A big question is whether the market really has an appetite for PSU bank papers. What's your assessment, and what happens? There could be more such offerings due.
So yeah, it will be very interesting because recapitalization of SOE banks is an important element of broader macro from fundamental perspective as well as market trajectory. And it's tough for me to say right now whether there's enough appetite for the kind of money is required. But yes, on the face of it, the valuations are attractive. But if you adjust for all the asset stress issues, then it depends on a specific bank. But then the valuations may not be as attractive. But yes, if they manage to get the recapitalization money, then the bank's balance sheet also improves. So it's kind of a chicken and egg story, and therefore a fairly interesting one for us to track, and would be an important data point and barometer for the broader macro and markets also going forward.
So like you mentioned earlier, overall the implied growth is actually too high, and there could be significant earnings cut going forward. Are there particular sectors where you think that this risk is probably significantly high?
In our view, top-down view looks like quite broad-based. So except possibly IT services and possibly metals and mining, the risk is there in every sector, from consumers to autos to financials. Cement clearly stands out. And even industrial cap goods stands out in terms of earnings cuts potential. But it looks like quite broad-based. It will be quite a broad-based cuts across the street, across the sectors.
If you were to pick one or two sectors where you think results will be quite good, and maybe there could be a potential revision upwards, which sectors would you really pick up?
So metals and mining could be one. Then auto two-wheelers could be another area where we could see positive surprise.
Okay, metals, minings, auto and two-wheeler. If you look at metals, really, the stock prices have moved up quite a bit, and stock prices generally track the commodity prices. Now, because commodity prices are kind of peaking, if you look at the trend over the last few weeks, and there are calls, we have seen some of the reports from top analysts who think that these commodity prices may not be sustainable. Now, what is the impact on stocks, earnings and valuations, and what would be your call on this sector?
So top down, we are neutral on the sector. Our view is also that the best is behind us in terms of re-rating potential, in terms of earnings growth potential. So unless we see a repeat of last decade's commodity super cycle, this sector best seems to be priced in already. Best seems to be behind us. So we won't be chasing this sector aggressively in a broad way. Select names could be interesting, but even in individual names, most of them, the risk reward is not attractive to buy at these levels.
Okay. And to talk about capital goods, you do see some stocks doing better this quarter?
So again, there are always companies here and there who deliver well because of market share gains, because of specific segments, etc. But a broader capital goods infrastructure, our view has been and still remains, there's no capex cycle recovery. And only where pockets where we see activity could be areas where we could see sectors and stocks specifically doing well. So for example, last 2-3 years it was roads, to some extent railways. Going forward, we could see some more activity in urban infrastructure, specifically metros. So those stock sectors can do well, but otherwise in a broad basis, we don't have any visibility on private capex cycle in the foreseeable future.
But do you expect power stocks to perform better in terms of earnings?
So power is a more defensive space. So if you look at the power utilities specifically, they are more defensive. So their earnings is linked to capacity utilization, the size of the balance sheet, which they have been delivering, but the stocks are now fully pricing that in. So they are more defensive characteristic stocks. So they should be okay. But we don't see any real positive surprise potential from a utility perspective. The power equipment guys, absolutely, we do think the risk reward is unattractive here because they are pricing in some level of recovery in the foreseeable future, while in our view, we don't see any power capex recovery happening soon.
Okay, so you are playing the consumption theme through auto stocks like you mentioned. What about FMCG? There was significant destocking in that sector as well. What have you picked up through your channel checks? Would this quarter now be better?
It should be better. So for a broader consumer sector, we do expect 7-8% volume growth in this quarter on a reported basis, and there will be companies which will surprise more positively on this count. So yes, this could be an interesting quarter for that sector.
Mm-hmm. Gautam, personally, you have had a really strong track record for picking up mid and small cap stocks. At this point of time, this segment is probably quoting at record high valuations. If you look at the premium between large cap and small cap to mid cap, what's your call really on this sector?
So as a sector, clearly, in fact, we've been wrong for the last few months because we thought valuations are in the frothy territory. But the sector has kept on outperforming in general. So I'm not comfortable in terms of risk, reward and valuations for the broader sector here, and would recommend being a lot of caution on this asset class. But as always, there are enough individual stories which still seem attractive and which still don't seem to be pricing inadequately the growth opportunity which is ahead. So individual stocks, they're still ideas, but yeah, as a broad category, I would advise caution.
Mm-hmm. But what do you really think is driving this segment? Is it because money is flowing into domestic funds and specifically into mid-cap funds, so the fund managers are kind of forced to buying, or what really are the factors behind this?
Absolutely, that's the only factor. At least in my view, fundamentals don't justify the kind of move we have seen there.
Mm-hmm. But there is also a logic that maybe in the short term there could be some correction because these stocks are quoting at a premium, but net over 3 to 5 years time frame, mid caps will still continue to outperform. So let us put more money into this segment itself. If you had to advise a retail investor, would you ask him to stay away from mid cap or kind of reduce the exposure to mid cap schemes and then wait for a correction?
So, I can't advise retail investors, that's not my mandate, but yes, in our client base, I do advise caution in terms of entering the small mid caps at this space. If you have it and you entered at a good price earlier on, you could still bet on holding on to these stocks from a 3-5 year perspective. But buying at these levels and hoping to make risk-adjusted good returns, even over a 3-5 year period, that seems an unattractive proposition to me.
Okay, well, one last question probably. IT is one sector you said is under-owned, and therefore you are turning a bit positive on that in terms of increasing exposure a bit. Would you have same views on pharmaceuticals?
Selectively, yes. Top down, we are still neutral on pharmaceutical as a sector positioning, but we do see select opportunities in couple of stocks. But the broader sector will still advise to be careful and not get into the attraction of bottom fishing. It's still not in real value zone. They look attractive versus recent history, and the visibility on the US generics business is still not completely clear, still clouded. So only selectively look at ideas in that space.